Hello and welcome to today's video lesson, an introduction to the bond secondary markets. This does follow on from the previous lesson, an introduction to bonds, but should also work as a standalone lesson. Let me just start by picking up where we left off last time. So we had a situation where our investor Andy had purchased a $100 bond from company XYZ. This pays him a $5 coupon and has a maturity of 5 years. So his future cash flows will be $5 every year for 4 years, then $105 in the final year, giving him a profit, if held to maturity, of $25. For the purpose of the example, we're going to say he purchased this bond, it was issued to him in January. So, well, let's say that September comes around, and now, and he's a little bit short on cash. He's run out of patience. He doesn't want to wait 5 years to realise the return on the bond. He'd like some money now. He'd like to sell his bond if he can. And he does this in what's known as the secondary market. The primary market is where bonds are issued from companies to investors. It can also be governments to investors. And in this case, the secondary market is where Andy is trying to sell his bond to someone else. Secondary market is where bonds are traded. So what we'll do is we'll look at two possible scenarios in September and see how they affect Andy when he's trying to sell his bond. One thing I'd like to introduce you to first is the phrase called default. Now default is when the issuer, in this case company XYZ, cannot make any more payments on the bond. Say the company goes bankrupt, they just don't have the money to pay Andy back. Now this is a risk that Andy and any investor must take when investing their money in a bond, and accordingly you'd expect a higher yield, a higher return for a riskier investment. If you're taking the risk that you may not receive any payments back, you'd like the potential chance to receive larger payments. So, let's say in September there's an earnings report for company XYZ and it shows, really bad losses. The company is really struggling, they've had a bad year, there's fear of bankruptcy in the future. However, company XYZ is still issuing bonds. They desperately need to raise capital. So how do they entice investors, given that they seem like such a risky investment? Well, what they do is they raise the yield on their bonds. So we say that the yields go up here on newly issued bonds, let's say to 7%. So if an investor now comes along in September and purchases a $100 bond, this gives them a $7 coupon. If, like I mentioned previously, you envisage a bond as, say, like a certificate, as a promise of future payments, and in this case here, this bond dictates a $7 annual payment plus $100 at maturity. We'll say that this bond also has a 5-year maturity, so it's a like-for-like bond with Andy's bond. As I said, if we look here, the payments promised by this bond, this IOU, are greater than on Andy's bond. But the current market dictates that for $100 you can get these returns. This is all from company XYZ. Andy is exposed to the same risk of default as this new bond. However, this is offering a greater payment. So you have to say, well, when an investor can pay $100 for $7 annual return, who would buy Andy's bond offering for $100 for a $5 return annually? Well, the answer is nobody. Andy's bond must fall in value. So we say, as yields go up, bond prices fall. Bonds go down. It's simply a case, in the secondary market, all previously issued bonds must adjust to current market conditions. So we say that because Andy's bond is trading at a price lower they initially purchased it for, his bond is trading at discount. Now let's look at the opposite side of things. Let's say in September the earnings report shows record profits. Company XYZ is thriving, is expected to be very cash rich in future years. In this case, they're deemed as a much safer investment, and thus they can lower the return they give investors because they know they're offering the privilege of quite a safe investment. So in this case, it would reduce the yield of their bonds, let's say to 3%. So a $100 bond now purchased in scenario 2 in September would only give an investor a $3 coupon. Just to clarify, so these are the annual coupons. So what we have to do is again compare the current market conditions to effectively the conditions that were current when Andy got his bond. Compare Andy's situation to the current market and we'll see that Andy has a greater return than this, so therefore his bond rises in value. What we say is as yields go down, bond values, bonds go up. In this situation, where Andy's bond is trading at a price above which he purchased it for, and his bond is trading at a premium. The key thing to take away from this is how risk of default, risk when entering a bond, can dictate the value of the yield of a bond, and also the relationship that yields move inversely to bond prices. These are two very crucial points. Thank you for watching.